Trading Forex can feel like navigating a stormy sea, confusing, overwhelming, and full of noise. Many traders get lost in endless indicators and emotional decisions, hopping from one strategy to the next, only to watch their accounts slowly drain. The truth? Consistent profits come from a simple, logical, and robust strategy, one rooted in the core mechanics of supply and demand. Forget the clutter. This approach brings clarity, focusing on how and why prices move, and where they're likely to go next. By understanding market structure, you'll start thinking like institutional traders, positioning yourself with, not against, the smart money. This three-step strategy is universal. It works on any pair, any time frame. We'll break it down into 3 steps. Media group, trader drawing support and resistance on chart, Forex chart with marked market structure, higher highs and lows. Stock would distribute equally, reading market structure, spotting key supply and demand zones, and executing trades with strict risk management. This isn't about chasing signals, it's about building a deep understanding that lasts your entire trading career. Remember, trading is a marathon. Success comes from many well-executed trades, not one lucky shot. Patience, discipline, and continuous learning are your real edge. Let's get started on your journey to disciplined, profitable trading. The first step is mastering market structure, the grammar of price action. Markets move in 3 ways: uptrend, downtrend, or sideways consolidation. An uptrend means higher highs and higher lows. Buyers are in control. A downtrend is lower lows and lower highs. Sellers dominate. Your job? Identify the trend and trade with it. Fighting the trend drains your capital fast. Consolidation means indecision. Price is stuck between support and resistance. In these phases, patience is key. Wait for a breakout before acting. Train your eyes. Mark swing highs and lows on a clean chart. Is price climbing, falling, or stuck? Without this context, every trade is a gamble. With it, you're making educated, high-probability decisions. Mastering market structure is the foundation for every trade you'll take. After identifying the trend, the next step is to find supply and demand zones, where price is likely to react. Demand zones are areas where strong buying caused sharp upward moves. Supply zones are where heavy selling drove price down. These zones act as support and resistance, and are where institutional money enters the market. Look for explosive moves away from small consolidations. These are your zones. Fresh, untested zones are strongest. Each retest weakens them. Mark demand zones at higher lows in uptrends, supply zones at lower highs in downtrends. This transforms your chart into a map of high-probability trade locations. Spotting these zones is a skill that grows with practice. With structure and zones identified, it's time to execute, where discipline matters most. In an uptrend, wait for price to pull back into a fresh demand zone. In a downtrend, wait for a rally into supply. Don't chase. Let price come to you. Before entering, look for confirmation. A strong reversal candle or a break in minor structure on a lower time frame. Place your stop just beyond the zone. If price breaks it, your idea is invalid. Set your target at the next key structure, previous high or low, or the next zone. This approach turns trading into a calculated business, not a gamble. Every entry, stop, and target is logical and planned. Let's see this in action with GBP USD. On the 4-hour chart, you spot a clear uptrend, higher highs and higher lows. Price pulls back after a strong push-up. You look for a demand zone, a small consolidation before the last big move, between 1.2350 and 1.2320. Mark this area, your fresh demand zone. Wait for price to return. As it enters the zone, drop to the 15-minute chart. Watch for confirmation. A bullish engulfing candle appears. Enter at 1.2345, stop at 1.2315, 30 pips risk. Target the recent high at 1.2500, 155 pips reward. That's a risk to reward of over 5 to 1. Place your orders and let the trade play out. By following this process, you've entered a high probability trade with clear risk and reward. This is disciplined, strategic trading in action. The real secret of profitable trading? Strict risk management, starting with your risk-to-reward ratio. Never take a trade unless you stand to make at least 2.5 times what you risk. This isn't optional, it's math. Even with a low win rate, a high risk-to-reward keeps you profitable. For example, win 3 out of 10 trades at 3-1, and you're still ahead. This rule forces you to be selective and patient, filtering out mediocre setups. Don't fall for easy wins with poor reward. They'll drain your account over time. Always calculate your ratio before entering. If it's less than 2.5, skip the trade. There's always another opportunity. This single rule will impact your results more than any indicator. Professional traders never compromise on risk to reward. While mastering this strategy is powerful, copy trading can supplement your growth, especially if you're short on time. Copy trading lets you automatically mirror the trades of proven professionals. Browse strategy providers, check their track records, and allocate a portion of your capital to follow them. It's a way to generate passive income and learn by watching real trades unfold. Study their entries, stops, and targets. See how pros manage risk. But be selective. Choose traders with long, consistent records and reasonable risk. Start small, test the waters, and use copy trading as a supplement, not a replacement, for your own learning. Used wisely, it's both a growth tool and a real-world education. You now have a clear, repeatable strategy for consistent trading. Step 1. Master market structure. Know the trend. Step 2. Identify supply and demand zones. Find where big money moves. Step 3. Execute with discipline. Wait for confirmation, set logical stops and targets, and never break your risk-to-reward rule. This approach gives you a real edge, even with a modest win rate. Practice on your charts, backtest, and build confidence through repetition. Consistency is key. Losses will happen, but strict risk management keeps them small. Trade smart, stay patient, and commit to the process. The market rewards discipline, not hope. Your path to trading mastery starts now.